My goal with this video is to get people to look deeper into the companies that they buy on the New York Stock Exchange before they buy them. So it's going to start off with some basic information, and then it's going to get much more technical throughout the end of the video with financial statement information and all of that. I like to start the videos by talking about a few books that I've read. Money, Master the Game by Tony Robbins. Tony Robbins isn't a huge investor himself, but he interviewed a lot of investors like Warren Buffett and Ray Dalio in this book and decided that buying index funds long-term, dollar cost averaging, by putting monthly amounts of money into index funds that are 500 to 1,000 stocks all at once to grow and grow and grow and compound over the years, and it creates a big fund that you can then give yourself, similar to an IRA. Warren Buffett, Ground Rules. He talks about how you should use the balance sheet and compare it to the price of the stock before you buy it. The Intelligent Investor by Benjamin Graham. He talks about, he is Warren Buffett's mentor from way back, early 1900s, and he buys companies that have dropped in value quite a bit on the stock exchange but still have strong financial statements. Same concept here, security analysis. Warren Buffett and Benjamin Graham both swear by these books. This is Graham and Dodd, and it is a huge book on security analysis. The easiest way to explain this is a timeshare. A timeshare is broken up into weeks. It's a house, it's broken up into 52 weeks, and 1 week is one piece of the 52, so it's one of 52. So if you decided that your house is worth $52,000 and you wanted to sell it as timeshares every single week, then you would just simply divide 52,000 by 52, and you would have $1,000. If you wanted to double that and you think your house is worth $104,000, then you would divide that by 52 and you would end up at $2,000 per share. Every single stock on the New York Stock Exchange has an amount of shares that you can multiply out and figure out what the market cap is. And if you wanted to buy the entire company, or if you wanted to buy the entire house, you can quickly see how much you're actually paying, whether you're buying one share or buying thousands of shares, or you're buying the entire company. It doesn't make a difference. You need to look at the financial statements and compare that. Marcus Lemonis is famous for his show The Profit on CNBC, and he has a formula that is assets minus liabilities, which is equity or book value, plus 3 years of net income. The 3 years of net income adds to the market value that he already has. So if you bought a company for $1,000 and they have $1,000 of equity, then you're buying it outright. But if there's positive earnings, then you're buying that company and you're adding some years into the future to get your money back. So he likes to use about 3 years for added income. So if the company has $1,000 in equity and he wants to buy it for $1,300, that would mean that the net income of that company per year is about $100. So he would start with $1,000 and then $100 additional per year to get his $1,300 back completely within 3 years. That's a very basic formula. Marcus Lemonis likes to really dig into the story of the owner. He also likes to see something like a chef who's really good at making different types of food, and he's great at it. He has a long story of how he started, but he just can't manage the business. So Marcus helps him manage the business side of things, but he also gives him a very fair offer for the company. Warren Buffett. He simply uses book value, or less than book value. So if a company is trading for $100 and there's 100 shares, then that's $10,000. He would pay $9,000 for that company. That's it. So there has to be a big decline in order for Warren Buffett to buy a company. He needs to look at companies that have been in for, he looks at companies that have been in business for 100 years. They've survived wars, they've survived all kinds of depressions and recessions, and then he looks at it when it's during a depression. He looks at a very, very solid company like McDonald's and Coca-Cola, and instead of buying it on the way up, he looks at things when they're on the way down, and the market capitalization goes down below the book value of the company. So they still have positive earnings, they still have a great balance sheet, but for some reason the entire tide of the stock exchange is going down, whether it's political reasons, recessions, depressions, wars, whatever it might be. In a turmoil type of situation, when everyone's pulling out and saying, oh my God, this is going to be awful, Warren Buffett jumps in. The hardest time to jump in. It's easy to think about, and it's easy to look back at a chart and say, oh, I should have bought here, but most people can't do that. It's very difficult. That's Warren Buffett's style. If I were to offer you a company for $1 million, you can buy it right now, and you know for a fact that you're going to make $350,000 for 10 years. Would you buy it? Would you buy 10% of it? Would you buy 1% of it? Would 100% versus 10% versus 1% make a difference at all if all the numbers were relative? If you know that you're going to make that amount of money over 10 years, that's $3.5 million, and you know that you only invested $1 million, so you know that it's a great investment. Of course you're going to do it. It makes sense, and you're going to make a lot of money. So a lot of people are jumping into stocks that are growth stories, like a Tesla or a technology company, or a lot of these brand new companies that are going to be the next Microsoft or the next Google. And it's very difficult to jump into those and just feed off of the positive news on a regular basis so that it keeps going up and up and up, further and further away from the equity on the balance sheet. The further it gets away from the equity on the balance sheet, it being the market capitalization, as the share price goes up higher and higher and higher, like a timeshare that's worth $52,000 and the shares are $1,000, and if all of a sudden there's a new construction going in near your town, near your house, and it goes up to $2,000, it goes up to $3,000, and then $4,000. Well, that $4,000 is saying that your house is now worth $208,000. Is it? Is it all of a sudden worth that much more? Maybe, maybe not. That's up for you to decide. There's different risk levels that you can really start to look into. And Goldman Sachs versus Facebook. The market cap right now of Goldman Sachs is $86 billion. Just think of 86. The equity that they have is 82. The income average per year over 3 years is 5.4. So if you wanted to buy the entire company of Goldman Sachs right now, you could buy it. You could buy every single share if they were for sale. So hypothetically, the share price right now adds up to the market capitalization. If you could buy every single share for that same price, you would buy it all for $86 billion. 86. Then if bad things started to happen, something happened to the income, your best income stream just fell off the books, your biggest customer, and you decided, oh my God, I gotta close the doors. Let's close the doors right now. You sell all of the assets, you pay off all of the liabilities, and you end up with the equity. The equity right now that Goldman Sachs has is $82 billion. So you would lose 4 right there in that situation. But you're buying it for 86 and you have 82. In 1 year, right now, their 3-year average is 5.4. So if you add the 5.4, it would take 1 year to get up and over that number. So as long as you hold it for 1 year, your customers don't change, nothing changes, you hold it for 1 year, then you get all that money back, and now it's possible to liquidate completely, sell off everything, close the doors, fire the employees, and you get all your money back. So it's a low risk. It's called low risk. It doesn't mean it's the best investment. It doesn't mean it's going to grow faster than Facebook or Google or Starbucks or Amazon. It doesn't mean it's going to grow faster, that the stock price is going to shoot up or anything. It just means that you're making a solid, risk-free, low risk, not risk-free, low risk investment. Now, Facebook. I'm not picking on Facebook, but that's just one of the technology companies. There are plenty of technology companies out there, and energy companies and pharmaceutical companies that are just like this. Facebook, if you wanted to buy every single share of their company right now, it would cost $561 billion. 561. The equity on their balance sheet right now, if they decided to close their doors and close everything, close down, it would be $54 billion. So you're in the hole $450 billion. You buy the entire company of Facebook today, 560, and tomorrow, all people just stop using social media for whatever reason. So the craze is gone. You decide you have to close your doors. You just paid $560 billion, and you can only sell your assets and pay off your liabilities and end up with 54. So that's an incredibly high risk. That means that the stock has just gone up and up and up and up and up, and you can't buy it right now. That doesn't mean that Mark Zuckerberg has done anything wrong. It doesn't mean that his company is bad. His company is great, but the demand for his shares have just gotten so high that everyone continues to buy it, and then it just goes way, way, way higher than the book value of what they actually have. So Mark could close the doors right now because he's already made billions of dollars. So even if he closed the doors and ended up with 54 billion, that's fine. But if someone bought it from him right now at 560 billion and then had to close the doors tomorrow, they would only end up with 54. So everyone buying these shares right now, you buy one share for $200 and you're only going to end up getting about $5 if they close the doors tomorrow. So buying one share today is the same as buying the whole company today. So that's incredibly high risk. It could go up and it could continue to go up, and their earnings could continue to grow up and their balance sheet could continue to grow, but that doesn't mean that their stock price is worth that much. So it's highly risky. They're a company that's only been in business for maybe 10 to 15 years. Buying it at that high of a premium right now compared to what you would end up with if you close the doors just creates a huge amount of risk for everyone buying that company right now. Citigroup is another company that's been in business for more than 100 years. Citigroup you could buy the entire company right now for $171 billion. Don't worry about the billion number and all the zeros. 171. You can buy the company for 171. They have equity right now. If they close their doors, paid off all of their liabilities, sold off all of their assets, they would end up with 173. So if you bought one share for, I think it's about $65, $66 right now. If you bought one share for $65 right now and they close their doors tomorrow, you would get back 67 because they would sell off everything and you would get back more. Facebook is the opposite. If you bought one share for $200 and they close their doors tomorrow, you would get back about $5. So the more shares you buy, the more of a risk you're taking there, and it could go up tomorrow, but you better get out kind of quick. So back to Citigroup, $171 billion to buy the company. They currently have $173 billion of equity. So their yearly earnings, the average for the last 3 years is $8.5 billion. That means that it's going to add to the 173. So add 8, it turns into 181. Add 8 turns into 189. Over 3 years, you're going to be looking at almost pretty close to 200 billion, and if the share price is still 65, that means you would get back almost $75 for every share that you buy if they close their doors. So again, it doesn't mean that their price is going to go up. It just means that Facebook's price is way up here and it's going to kind of trickle back to where it is, or the balance sheet is going to trickle up to get to that number, and they have to match. The financial sheets have to match that stock price, or else it comes back down. Or if the share price is down here and their balance sheet is up here and it's been ignored for a while, like financial companies have been ignored for a while because they got everybody into debt, they needed bailouts, well, they're starting to come back to that balance sheet level. And that's where the risk reward ends up being a lot less. You don't have that much risk when you're buying a company like that. Toyota Motors, been in business for probably about 100 years. I didn't look up the exact amount. You could buy the entire company for $187 billion. They currently have equity of 157. So you would lose, if you bought the whole company, you'd lose $30 billion. If you bought it today, sold everything off tomorrow, you'd lose $30 billion. But they make $18 billion per year. So 2 years and you get your money back. Facebook, if you bought the entire company for $560 billion and their equity right now is 54, and their average earnings over the last 3 years are about 9.9, call it 10, that would take you another 10 times 10 is 100 billion. So you have 54 to start with when you buy the company, plus 100 billion in 10 years. That gets you to 150. You're still not anywhere close to that 560 number. It would take you 30 to 40 years to get your money back, even including the equity that you're already getting when you buy the company. So it doesn't make any sense to jump into a company like that, other than to do it for the short term in hopes that more good news is going to come out and the price will go up a little higher and you can jump out and make a profit. But to hold that for long term, I see it adjusting downward to get closer to that balance sheet, and if not, then that balance sheet is going to have to grow incredibly fast to get up to that 560 number, from 54 to 560, and they're only making 10 per year. So it's going to take 50 years, 40 years to get your money back on that investment. So either it's going to take 40 years at the current level, or their earnings are going to increase tenfold, and it's going to take 5 to 10 years to get it back. But that's just a huge risk to take. Again, it's just a huge risk, and even that only gets you to even. When you buy Toyota today, or Citigroup, or Goldman Sachs, you're even on day one, or well, maybe after year one or year two, but all within a year you're even. And Facebook, you're not. So I understand buying some of these companies. I understand what people are thinking, and I understand that their growth, they're looking for something that's going to grow faster. But you've got to look into the financial statements and the balance sheet and the income statement, the cash flow statement, see what these companies are doing with their money. And if you don't understand it, at least look at the bottom number. The very bottom, just go to the balance sheet, go to the very bottom number, make sure it's positive, make sure it's pretty close to the market capitalization number, and go to the bottom of the income statement, make sure the last 3 years are positive, make sure they're kind of increasing at least a little bit. And the cash flow statement is I know it's difficult for people to understand, but the cash flow statement will tell you if they're taking on more debt or paying off debt, if they're paying a dividend or not paying a dividend. So the companies that have been in business for 100 years, like Citigroup, Goldman Sachs, and Toyota, all pay a healthy dividend. They each pay at least 1%, and Toyota pays 3% dividend. Facebook pays no dividend. They think that they need to continue investing their money into buying Instagram and making an offer to buy Snapchat for $1 billion and possibly growing their income in the future. But maybe they will, maybe they won't. It's a huge risk. Buying these other companies is not as big of a risk. If you looked at Disney, that's a company that's been in business forever. McDonald's and Coca-Cola, they aren't automatically good investments just because they've been in business forever. But if you look at the balance sheet, the equity of the balance sheet, and it's close to the market cap, then that means it's a great investment if they have positive earnings. Here is a list of the top 10 investments by risk, starting with the lowest, a savings account. Very simple. You don't make any money. You would technically lose money to inflation because the government prints more money every single year, and you would lose a little bit. If the government has $100 billion of US dollars out there in circulation and they print another billion, everybody's dollar just went from being worth $1 to worth 99 cents. It says that it's worth $1 and you can pay $1 for things, but all of the prices around the world will increase by 1% in order to make up for that. So over the years, your grandparents probably bought a house for $10,000 and your parents probably bought a house for $75,000, and you today would have to buy a house for $250,000. So yeah, prices just always go up. A Coca-Cola used to cost 50 cents and then $1 and then $2. So prices go up because of inflation, and inflation happens because the government prints more money. So keeping your money in a savings account, not making any interest on it at all, is technically losing money every single year. Certificate of deposit, a CD. At your bank, you can call or just go online and buy a CD. You don't even have to buy it technically, you just transfer your money into it. They hold your money for 6 months, a year, 5 years, and they give you maybe 1%, depending on how long you do it. I think the maximum right now, June 2018, is about 2% if you put it in there for about 5 years. So 2%, that'll kind of hold up to inflation and at least keep your money even. Government bonds are third, number 3. Government bonds, a government will issue out 1 million shares or 1 million shares of a bond. They're trying to collect $1 million so that they can create a post office, and once they build that entire post office, then that's what they use the money for. So different government things like roads and signs and all different things that governments do, they put out $1 million worth of bonds. People buy those bonds, mostly companies do, but people can buy those bonds. They get 3 to 4% on it, and when you were younger, you used to buy a paper bond, and you would buy it, and it would be backed up by the government, because the government is the one that's using it to pave the roads and to make street signs and do all different traffic lights and all that stuff, pay the police. So all of that money goes towards those things. So the government will issue out some more money, people give the government money, and then they pay you back interest because they need that money up front. That's the third risk level. The fourth risk level is corporate bonds. Corporate bonds are very similar to a government bond. A company like Apple or Home Depot will issue out $1 million worth of bonds, and they put out 1 million shares at $1 a piece. You buy the bonds, you buy as many of them as you want, and when you buy them all of that money will go to the company. They raised $1 million, they'll work on a project that they do, and that's debt for the company. They're going to pay you interest on that. You don't have a specific interest in that investment that they're working on. You are simply just creating new debt for that company. Now, the reason that is only the fourth risk level is because a company, if I own shares of a company and you own the corporate bond, you're going to get paid off before I get paid off. So like I was saying earlier, if the company has something tragic happen today and they have to close the doors tomorrow, everyone's going to have to get paid off. Similar to a real estate, someone who owns a house and they have to sell it for $200,000 today and they still owe $190,000. They pay the bank the $190,000 and the owner gets the extra $10,000. If there were 10 owners of that property, each one of them get $1,000. So if there was an additional $20,000 home equity loan, well, the primary loan holder would get their money first, the $190,000. The second lien holder, which is the home equity loan, would get their money second, and since there's not enough to cover that, they would get half of that money, and then the owner of the house or multiple owners would get nothing. So the same thing happens in corporate. The shareholders are last on the list, which makes it more risky. So that will come a little bit lower down. But corporate bonds, they just raise money to work on a project, and it's another way of raising new debt for them. Very simple. The fifth risk level, the next most boring one, 401k, IRA, index funds, and mutual funds. All of them are pretty similar. They all make about 5 to 6% per year, and you maybe get a 2 to 3 to 4% dividend at the end of the year, but you also pay about, 1% or less for the company that holds it. So if your 401k is with Vanguard or with Schwab, then you pay a 1% fee per year, or whatever that percent is. A lot of them are getting lower and lower depending on how much effort it takes. So the actively managed ones are mutual funds. You mutually come together with a bunch of people, put all of your money into one person or multiple people, and they actively invest your money into Facebook and Amazon, and they pick it because they're supposedly very good stock pickers. So they pick these stocks, and then they sell them, and then they pick more, and then they sell those, and they have a good track record that beats the Dow Jones and beats the normal 8 to 10% per year. And maybe they last 5 years, maybe they last 20 years, and some of these people go down in history, and other of them just go down, and that's it. So mutual funds are a lot different. An index fund is a safer version. The mutual fund is more risky because you're kind of like hoping for people to pick the right things for you. So you need to really trust that person. And if you ever do get involved in a mutual fund, you should really look into who's running the mutual fund and if they're involved, if their money is in it. So if I was to collect $1 million from a bunch of different people and say that I'm going to invest in these different things, then all of you should hope that I have my money invested in that as well, because the fund that I'm using to buy and sell all of these different things, I'm going to take a lot more care in thinking about each one of those investments if I have my own money invested in it as well. So you should really look into who's running that and if they have their money in it as well. That's a mutual fund. The index fund, you're just following the Dow Jones, which is the top 30 stocks, or the S&P 500, which is the top 500 stocks in the New York Stock Exchange. There's no people actively managing it, and it's a very, very cheap, low yearly fee to have that because it's just simple. 6 through 10. Real estate is more expensive to get into, but it is a great investment. It can make even more money than all of these other things that I've talked about so far, the more boring things, because they don't make that much money. They're boring. That's it. They don't appreciate. Savings account doesn't appreciate in value. Corporate bonds and treasury bonds or government bonds and all of those different things, they don't really appreciate in value like real estate or stock prices do. Stock prices appreciate in value over the years, and that's what people really, the dopamine hit that people really want, and the euphoria is that the stock price goes from 0 to 100, not that they collected 3% per year or 10% per year on average. So a lot of people think they should diversify and know that they should diversify into multiple stocks and multiple companies and real estate and all of these different things, but they don't, because they really want that dopamine hit of getting a stock that's $1 today and it goes up to $200 tomorrow, and they multiply their money by thousands. Real estate is something that goes years and years back, and I love real estate because it's owning a piece of earth. People always need a place to live, and whether they rent or whether they own, it doesn't matter. People will always be willing to buy your property, and people will always be willing to rent your property. So whether you're a landlord and you're renting out a bunch of properties, or you're an owner and you want to, buy one and then move into the next one and rent out the old one, and then move into the next one and rent out the other one slowly, then that's a great way of investing the money that you've saved. Over the years, you're going to start saving money into your savings account, and as you save money into your savings account, you're going to want to put it into commodities or corporate bonds or treasury bonds or real estate or all different stocks. So you have to pick one of these risk levels and decide which one do you really want to get into. And a savings account is the absolute lowest risk. If that's all you're willing to risk, then that's all you want to do, save your money into a savings account and leave it there. The next risk level is a CD, and if that's all you want to do, that's fine. But if you want to start getting involved in real estate, then that's definitely one of the options. Number 7 is companies, stocks, businesses that have been in business over 100 years. So this doesn't involve the newer technology companies, the newer energy companies, the companies that have been in business for less than 10 years. I'm talking about companies that have a great balance sheet, a very, very high amount of equity that is very close to the market capitalization. They've been in business for 100 years, which means that they were in business during recessions. In 1929, in 1985, Coca-Cola was still around. During the worst times in the world, people were still drinking Coca-Cola and eating McDonald's hamburgers. So those are great companies to invest in. Just pick the right time during the ups and downs. When there's a down part, jump into McDonald's. It's a great thing to have, and start buying it monthly. Don't hold all of your money. Don't save up $10,000 into a savings account and then just jump all into any stock. It's never a good idea. You should take that $10,000, instead of putting it into your savings account, slowly put it into McDonald's when it's going like this and like this and like this. It's called dollar cost averaging, and it's the greatest way to invest in a company, because you buy it high, you buy it low. You don't sweat when it's a little higher, you don't sweat when it's a little lower. You just simply continue to put $100 a month into McDonald's. And after a year, you say, you know what, I'm done with McDonald's. I'm going to leave that there forever, and I'm going to start putting $100 into Coca-Cola. And you just continue doing it for another year. And then when you find something new that you really want to jump into, that's when you say, maybe you own 3 houses and you have a bunch of McDonald's stock and you have a bunch of Coca-Cola stock. Maybe that's a great time to jump into something that's much more risky, and maybe it can go up over time. So the next one is growth stocks, which are the newer companies, the energy companies that are trying to disrupt the older stuff. So Tesla is a good one, solar panel companies, energy, pharmaceutical companies that are trying to think of the next thing to cure cancer. When they do cure cancer, there's going to be a snap of a finger and the company is going to just skyrocket. So that's a very risky thing to have because they have so much research and development going on. They're paying doctors and research technology and computer systems and databases, and they're paying for all these things before they actually sell their pills. And then they have to go through all kinds of government approvals and everything before they actually get the pill approved. So there's different stages involved that they get more investment dollars and they start making these pills, and then they finally end up selling them. So it's a very long, tedious process of growing that, and the balance sheet is almost non-existent during that process. So it's a growth company and it's a huge risk, so that's why it's higher on the risk level. If you want to jump into a company that says that they're going to cure heart disease or they're going to cure cancer, then great, jump into it, but it's a high risk. It could just do the opposite. You have just as much of a chance of going down as you do of going up, and it's very risky. Technology is involved in that. All of the newest technology companies. Social media may not be around forever. It may be around forever and it may grow and multiply. So again, it's a risk. It's a huge risk. And like I said with Facebook already, their balance sheet is only at $50 billion, but for some reason their market capitalization is up to $560 billion. So it's an 11 times their balance sheet, which it just, to me, that makes no sense to jump into a company at that point because it's just too high. Their balance sheet they need to make more money. They need to put more money into their savings account, which is their balance sheet. And once the money gets into their savings account, that's when it's worth more money. So people have high hopes on it right now, but it may not be the best time to jump in. After growth companies comes commodities, gold, silver, copper, all of these different commodities that people can jump into. They don't pay dividends. They don't have any kind of income per year. A lot of the bigger companies that have been in business for a very long time, risk number 7, these companies that have been in business for 100 years pay a big dividend. So you're getting that passive income per year. Even if your stock price goes down by 10%, you haven't sold it. It doesn't really matter if you do sell it. It's an investment that you're trying to hold for a long time, and you're getting that 3% passive income along the way. So passive income, you're making $10,000 every few months from your job because you're working hourly, and you can choose to work more hours if you want to, or you can take that money and put it into something that makes 3 to 5% or 10% or collects a dividend, and that income is coming in while you're sleeping. It doesn't, you can continue adding to it and you continue getting that 3%, and eventually if that covers your entire salary, you don't have to work anymore. It's called passive income, where it's not direct where you're working for that stuff. You have it and it's just continuously coming in all day, every year. So that passive income is important. If you buy Facebook or growth companies or commodities, that passive income is not there. If you have real estate and you have rental income coming in on a regular basis, that's passive income. There's some work involved in it, but it's not that much work. You set up the lease, you get somebody in, you make sure that you're making more rent than your costs of taxes and mortgage payment and possibly a condo fee of some sort, but you make sure that your income is more than that, and then you start making $400 or $500 a month, and every once in a while they might call to check something, or treat it as customer service, and make sure that you treat your customer well, and make sure you treat your rental person very well, and every time they call you, make sure that you're at their beck and call, because they're only going to call once a month. It's not that big of a deal. You're not working 40 hours. Commodities and foreign currencies. It's just way too much to try to get into in this video, but if you wanted to exchange your money for Canadian dollars, USD to Canadian, because the Canadian dollar is going up faster, it's kind of like betting on governments. If the U.S. government maybe has some political problems going on, and you think that the Canadian government is doing really well and that their economy is growing faster than the U.S. economy, then their dollar is going to be worth more than the U.S. dollar slowly. So if you want to bet on China's economy and you think that their economy is going up, then transfer your USD money into China's currency or Canada's currency or whatever country you choose if you think that they're doing really well. And the US dollar is one of the most powerful currencies forever, so it's probably not that great of an idea to transfer it, but again, it's just one of those things that people transfer back and forth, and they play a game of charts, and sometimes they're going up and sometimes they're going down, and sometimes people make money on it. So if you really wanted to get into that, that's something that you could do. And if there's a big problem with the Canadian government going on, their dollar might start to drop. Just like if there's a big problem at Facebook, their stocks start to drop. So there's different things that you can play and games that you can play with that. So again, it's a high risk. It's kind of like gambling in a way, but you're betting on the news situations. And again, no dividends there. There's no passive income. You could hold gold for 15 years and it could continue going up and up and up, and you're like, this is such a great investment, I'm so glad I did it, and all of a sudden it drops down to where you bought it, and now you're even again and you never collected a dividend on it. But you could have real estate and it goes up and up and up, and then it goes down below the price that you paid for it, and it stays below there for like 15 years, but you're collecting that income the whole way along the way. So you really are excited still that you've collected all of that rental income. Someone else could be paying off your house for you, or you could be collecting that cash flow and putting it into gold if you wanted to, or something else as you collect that income. So that is where the passive income part of it really comes into play. That's when you're buying Toyota versus buying Facebook, you get the 3% dividend. So if Toyota stock goes up and then down, up and then down, and then it stays below the price that you bought it for 5 years, you're still collecting that 3% dividend passive income that you can use for something else and continue to grow your money. But if you have Facebook, you're not going to get that dividend right now. Maybe they will offer it later on, but right now they're not. The 10th risk level, the highest risk possible. If you really wanted to bet your money on something, then here you go. Cryptocurrency, penny stocks, day trading, and gambling. Those are the absolute riskiest things that you can do with your money right now. Cryptocurrency is brand new. It's one of those things, again, there's no dividend. It's a type of commodity, or people are calling it a USD type of thing. It's a currency or it's a commodity. There's arguments about it. There's news, there's regulation. There's just so much going on. But the enthusiasts love it, and they think that the network is going to continue to grow. A lot of people are saying that the cryptocurrency value is based on the amount of electricity that it takes to produce one. So if you bought some sort of Bitcoin miner and you plugged it in your house, and it cost you $7,000 per month of electricity to mine one Bitcoin, and you collected one Bitcoin, then you'd want to sell that Bitcoin for more than $7,000. So all of the people out there that are mining these cryptocurrencies are paying the electricity to mine them, and as they get them, they want to sell them for a little bit more than that. So the intrinsic value, the price goes up and down, and it fluctuates because people are buying and selling them, and there's demand and there's supply and all of that. But really, the intrinsic value is how much it costs in electricity to do it. If everybody stopped plugging them into their wall, and they started using solar panels, it would be a little bit cheaper, and it would be cheaper to mine the Bitcoin, and then the people who mine them would sell them for a little bit cheaper because they would make a profit at a lower price. So that's where these things are really starting to go into effect. So if you really want to look and see if Bitcoin is worth what you think it's worth, then go on and look for a calculator and see if you can make money on mining. And if you can make money mining, then all of those people out there are using those things to mine the cryptocurrency, and then once you mine it, you can sell it to somebody else for more than it cost you to mine it. But if you can't make money on it, then it's probably not worth that price that it's at right now. Penny stocks are companies that are not really regulated as much as the New York Stock Exchange. You're hoping that something's going to go from 0.0001 to 0.001, and you multiply your money times 10, so people buy 100 of them in hopes that one of these companies is going to grow and a bunch of people will buy it. And they're very difficult. They don't really have financial statements available and easy to look at financial statements, so it's difficult to see what the market capitalization is compared to the balance sheet and the equity and the income, because there's just not much information available for them, and it could be sketchy misinformation, so be careful looking into that stuff. And if you want to trade them back and forth, again, chartists, there's technical chartists out there that say that there's certain reasons that people will continue to buy something, and that a certain swoop or loop or line turns into another swoop or loop or line, but ultimately the balance sheets do the talking. If you have no money in the bank and you have no income, you have no company. So that's it. That's all there is to it. Your chart could be going up and down and sideways, but it doesn't matter. Tomorrow's chart is determined on the balance sheet and the financial statements, and that's what this is all about. Look at the financial statements. Day trading, good luck. Gambling, good luck. That's all I have to say about those things.